The Forex market is often described as global, but in reality, it's powered by regional economies. Each region, whether it's North America, Europe, or Asia, plays a critical role in shaping currency movements around the world. Understanding how these regions influence Forex trends can give traders a major edge in predicting shifts, spotting opportunities, and managing risk. Let's break it down. First, the role of regional economic strength. Every currency reflects the economic health of its country or region. When a region's economy performs strongly, with rising GDP, low unemployment, and steady growth, its currency tends to appreciate. Take the US dollar, USD, for example. When the US economy shows strong job data or solid manufacturing output, global investors buy more dollars, viewing it as a sign of stability and strength. On the other hand, if the Eurozone reports slower growth or political tension, the Euro, EUR, can weaken, even if other economies are performing well. That's because Forex traders react not to one country, but to regional signals that affect global balance. Second, the time zone effect. Each region also influences Forex trading through timing. When Asian markets open, currencies like the JPY, AUD, and NZD become more active. Later, as Europe and then North America join in, volatility rises. This sequence, from Asia to Europe to the US, creates the rhythm of the global Forex market. Major economic releases from one region can set the tone for the next session, creating waves that travel across the world. That's why traders often align their strategies with regional sessions, anticipating when liquidity and volatility are likely to spike. Third, trade relationships and interdependence. No region operates in isolation. When China's economy slows, demand for raw materials drops, which can weaken currencies like the Australian dollar, AUD, that rely heavily on exports to China. Similarly, energy prices impact the Canadian dollar, CAD, because of Canada's oil exports. And political shifts in the Eurozone can ripple across markets, affecting the British pound, GBP, and even the Swiss franc, CHF. In other words, regional events can cause global chain reactions, and Forex traders are constantly watching these interconnections. Fourth, monetary policies by regional central banks. The policies of central banks, like the Federal Reserve, European Central Bank, and Bank of Japan, have massive influence. When one region tightens interest rates while another cuts them, traders immediately shift capital toward higher-yielding currencies. This constant balancing act drives much of the global Forex flow. That's why understanding regional monetary policy isn't just academic, it's practical. It tells you where the money is moving next. Finally, the power of regional events. From elections and inflation reports to natural disasters or trade wars, regional events can quickly turn into global market movers. A drought in a major food exporting region can raise global commodity prices. A regional banking crisis can erode confidence in multiple currencies. Even social unrest in one area can push investors towards safe haven currencies like the USD, JPY, or CHF. In Forex, regional headlines can have global consequences, often within minutes. In summary, the Forex market may be global, but it beats to the rhythm of regional economies. Each region adds its own pulse, its own data, politics, and monetary signals to the world's financial flow. Successful traders don't just follow charts. They understand where the moves begin, why they happen, and which regional forces are behind them. Because, in the end, global Forex is simply the sum of many local stories. And the better you understand those stories, the sharper your trading vision becomes.